Classifications are so important, whether it's buying apparels, small, medium, large or XL, or understanding or selecting a debt mutual funds. Today, if you see majority of the portfolios in debt, it's bhelpuri. People have got short-term, medium-term, long-term, gilt, duration, credit, and they don't know what is the interest rate risk and the credit risk in the entire portfolio. Let's try to understand the 16 various types of debt mutual funds as per SEBI's classification so that we can select a right fund for the right objective. Now let's first start with the funds and the bucket, which can be a good alternative to a saving account and a current account, which generally Indians use for transactional purpose. The first alternative can be an overnight fund. An overnight fund is a fund where the debt instruments have just 1 day tenure. So the interest rate risk in an overnight fund is practically not there. Second, a liquid fund. A liquid fund, as per SEBI's classification, can have debt papers with a tenure of up to 90 days. So yes, the interest rate is slightly higher as compared to an overnight fund, but very low because the tenure cannot have, the tenure of the bonds cannot be more than 90 days. Third, which is called as an ultra short-term fund. An ultra short-term fund, as per SEBI's classification, has to have Macaulay duration between 3 months to 6 months. So the interest rate risk band is defined 3 months to 6 months Macaulay duration. If you have an horizon for 3 months plus, then an ultra short-term fund can be a very good alternative. Up to 3 months, liquid funds can be a very good alternative. And parking your money for a few days, overnight fund can be a good alternative. Now coming to the fourth fund, which is called as a low duration fund. A low duration fund, as per SEBI's classification, the interest rate band is between 6 Macaulay duration to 12 Macaulay duration. The fund manager can only manage between 6 to 12. So obviously the interest rate risk in a low duration fund is higher than an ultra short term fund, but still very low because the Macaulay is just between 6 to 12. If in case you are parking your money or investing your money for more than 6 months, a low duration fund can be a very good alternative. The last one in this category for parking your money can be a money market fund. A money market fund is that fund which invests only into money market securities. And we all know money market securities are those securities like a bank CDs, certificate of deposit, or commercial papers of corporates, or T-bills, treasury bills of governments, and they have a tenure of less than 1 year. So money market typically invests into debt instruments which have a tenure of less than 1 year. So you understood the first category: overnight, liquid, ultra short term, low duration, and money market, used for predominantly parking your money. Now let's try to understand the second category, and then we'll go to third and fourth category. Second category can be possibly there is similarity between fixed deposit. It can be a replacement for fixed deposits. Starting with first, which is called as a short-term fund. A short-term fund, the interest rate risk is defined as per SEBI's classification. It is between 1 year to 3 year Macaulay duration. So in a short-term fund, you know that the fund manager will actively manage between 1 to 3 years Macaulay duration. But it doesn't talk about the quality of papers which a fund manager can choose. And that's why it is important to look at the credit portfolio before selecting a short-term fund. If it is matching as per your risk appetite, you can select that fund. Second is a corporate bond fund. A corporate bond fund, as per SEBI's classification, 80% of the instruments has to be, the debt instruments or the debt papers have to be AAA, at least 80%. You can have 90, 10, 100%, but at least 80% should be AAA. The classification doesn't talk about the tenure of papers. So there can be few corporate bond funds which have got low interest rate risk, some have got medium, some can have long. So please look at the interest rate risk when selecting a corporate bond fund. Third in the category, which can be possibly a replacement for fixed deposit, is a banking and a PSU fund. A banking and a PSU fund, as per SEBI's classification, talks about the debt instrument papers can be from banking or a PSU category. It doesn't talk much about the interest rate risk, the tenure of papers. So it's very important. Besides looking at the portfolio, also important to look at the interest rate risk in a banking and a PSU fund. Now, these can be good alternatives to a fixed deposit, provided you have checked the interest rate risk and a credit risk in these funds. Now coming to the third category, which has got higher interest rate risk. This category is called as medium term fund. We discussed short term, the Macaulay should be between 1 to 3 years. In a medium term, the interest rate risk is higher. The Macaulay duration is between 3 to 4 years. So the interest rate risk is higher. It doesn't talk much about the credit quality. So please look at the credit quality before investing into a medium term fund. Now, medium to long term. Obviously, it has more interest rate risk. The Macaulay duration fluctuates as per SEBI classification, can be between 4 to 7 years. So obviously, it has got higher interest rate risk. Look at the portfolio quality. Nothing much talked about the quality of papers which can be there in this medium to long term. Then long duration portfolios. In this, the Macaulay duration has to be more than 7 years. So if a Macaulay is above 7 years, the interest rate risk in this fund is extremely high. Credit risk, we all know, you invest into low rated papers and you get higher yields because of that, and possibly higher returns because of that. For clients who typically are looking for higher returns and can take credit risk, a credit risk fund is a very good option. As per SEBI's classification, a credit fund should have at least 65% portfolio below AAA. They can have up to 35% portfolio into AAA kind of securities, but at least 65% should be below AAA. Then you have a portfolio which is called as dynamically managed bond funds. Dynamic managed bond funds, typically the fund manager can dynamically change the tenure of bond portfolios based on their view on interest rates. So obviously these funds will have a very high interest rate risk, and there'll be a lot of fluctuation in tenures based on a fund manager's view. High returns, high risk in these categories. Lastly, there are funds which typically have got constant tenures, which is like a 10-year constant maturity gilt fund. In this, the tenure of a fund will always be 10 years. It's like a passive strategy. Then you have got gilt funds. A gilt fund, as per SEBI classification, it says at least 80% of the portfolio should be into government securities. It doesn't talk much about the interest rate risk, but generally when you take gilt and long-term papers, the interest rate risk is very high. So try to understand the strategy, try to understand the interest rate risk before selecting into this fund. Last but not the least, a floating rate category. In this, at least 65% of the portfolio should be into floating rate instruments. I hope you all understood the 16 various classifications of debt mutual funds. A small 1-minute quick recap for all of you. First, an overnight fund, no interest rate risk practically. A liquid fund, only tenures up to 90 days, very low interest rate risk. Then an ultra short term fund, Macaulay between 3 to 6 months. A low duration fund, 6 to 12 months Macaulay duration. A money market, only tenure which is less than 1 year. A short term fund, interest rate risk between 1 year to 3 years. A banking and PSUs, only investing into banking and PSU securities. A corporate bond fund, at least 80% into corporate AAA securities. Now coming to a little higher risky categories like a medium term. In this, the Macaulay duration is between 3 to 4 years. Or a medium to long duration, the Macaulay duration is between 4 to 7 years. A long duration fund, Macaulay is above 7, very high interest rate risk. Or a gilt fund, at least 80% should be into gilt securities. It can have possibly high interest rate risk. Then credit risk fund, a very high risk category because it gives you high returns, but it invests into credit papers. Then a dynamic bond fund, where a fund manager changes his portfolio based on view on interest rates. Very risky, but possibly high returns. And last and not the least, passive strategy, where you take a 10-year constant strategy, and then the floating rate fund, where 65% of the portfolio should be invested into floating rate securities. I hope you all understood the classification. This can make your life somewhat simpler. Happy investing, stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.